Okay, I think we are live with the Anderson Report. This is Thursday, October 1st. This is the first day of the fourth quarter, and we have a little bit of a new setup today. So if I'm glancing around at a couple different screens, just bear with me. But the market today seemed to be very much dominated by back and forth chatter on the potential for a stimulus program, although we did have quite a bit of very positive economic data. We're going to get into all that. We're going to talk about what the market did out of the chute, day one, Q4. This is the Anderson Report. I am Tim the Source Anderson. This is my YouTube channel called The Anderson Report. If anyone is new to the broadcast, please subscribe by hitting the red subscriber bar on YouTube and hit the little bell next to it. You will get notifications on when the next broadcast is. I also broadcast on Periscope on TJ Anderson 12. And I broadcast on my Twitter handle, I should say, is TJ Anderson 1. So we're going to get right into it now with the market activity today. Stocks started off with a positive tone. The Dow was up as much as 1%. The S&P was up a little bit more than that. NASDAQ was well bid and strong all day long, finished the day stronger as the Dow, the transports sold off a couple of different times during the day. Didn't close at their lows of the day, but certainly closed well off their highs. NASDAQ closed a little bit off its highs. And actually, the Russell 2000 had a pretty constructive day, which surprised me a little bit. But the Dow gained 35 points. So that's like 0.1%, 27,817. It's some major components sold off. Energy was extremely weak. And the S&P 500 actually gained 0.5%. So the S&P 500 closed at 3380 spot 80. Now, let's remember that the old all-time high for the S&P 500 before we had that big rally at the end of August, the old high from February 19th was 3386. That's the level that I'm going to watch on any further strength in the S&P. It was above it for a while. Midday, couldn't hold that level. It closed at 3380 spot 80, up 0.5%. But watch that old high from February 19th, 3386, if the S&P rallies again tomorrow. The NASDAQ Composite closed at 3326, up 160 points. That's a gain of 1.4%. It acted very well all day long. It almost acted like the NASDAQ acted back in July when you just had this relentless push to these big mega cap internet stocks and internet what we call the internet traffic trade stocks. The NASDAQ closed at its best level since September 3rd. Probably now close to 2% above its 50-day moving average. And I think at a really critical level at 11,326, that's where it closed. We highlighted yesterday that on August 21st, just before we had that last big 8-day rally before the top, the NASDAQ closed at 11,312. It closed at 11,313 on September 4th. It got through those levels, closed at 11,326. Be very interesting to see if NASDAQ can follow through on that rally tomorrow. So the Russell 2000 had a nice day also. It gained 1.6%. I was maybe a little bit surprised to see that, although I think it was aided significantly by some positive chatter early about the potential for a stimulus 2.0 plan. But the market really got hit also late in the day. The Dow and the S&P came well off their highs on, I think, the reality that there are still a couple of major hurdles to get this done. It might happen, but it's not going to happen without a lot of back and forth comments that probably whip the market around with some more volatility over, the next few days and into probably at least the middle of next week. It's interesting that the Russell closed at 1531, 2 points below its 50-day moving average of 1533. And we will just have to see if the Russell can get through that level tomorrow or early next week. So the breadth of the market was certainly positive. You had both on the New York Stock Exchange and the NASDAQ exchange. You had two stocks advancing for every one that declined. That is certainly a positive indicator. And you had, in terms of sectors, you had the stocks that have been leading what I've always called the internet traffic trade. They were some of the best performing names, clearly supported by the fact that NASDAQ gained 1.4%. Communication services up 1.4%. Information technology up 1%. The other stocks that acted well, consumer discretionary, the similar theme that we saw when the market really had legs in July and August. Consumer discretionary up 1.5%. Energy just continues to be not a good story and a big drag. If there's a drag on the S&P a little bit, it's the energy stocks down 3.3% today. The crude oil was down 4%, down $1.60. It had closed just above $40 yesterday. It was down $1.60 to go out at $38.60. Again, we would like to see crude oil get back above the $40 level. That would give us confidence that the global economy is strengthening. And I think that crude oil above 40 would be a healthy sign for the market overall also. So we had a significant amount of economic data today, and we're going to get right into that right now. Thank you, John, for joining. If you see me glancing my eyes around a little bit, I've got the monitor not exactly where the camera is right now because I've got a new camera, and if everything seems to be possibly a little bit more in focus, that's why. If you have any comments about any of the visual effects of the broadcast, please shoot them to me either here or on my Twitter handle later, because I'm interested to see what the feedback is on this new camera setup. And that's for anyone else that might be in the watching, but not necessarily active in the chat. So, look, we had a blockbuster day for economic data. I just want to get my notes in front of me here. So we started the day, of course, with the weekly first-time unemployment claims, a little bit of improvement, 837,000. Consensus was for 850,000. We still want to see that number make a big leap to the downside, but we probably can't get there until you get the economy opening up beyond these 25 to 50% capacity restrictions in restaurants, bars, hotels, any indoor activities. There are just too many ancillary services and support jobs that rely on an economy that's fully open rather than an economy that's open 25 to 50%. I think that that is the big stumbling block toward getting those first-time unemployment claims to drop hard below 800,000 a week. So, the positive side of this was that continuing claims. Now, the first-time unemployment claims were for the week ending September 26th. The continuing claims report was for the week ending September 19th. And there were close to 1 million people that dropped off the continuing claims rolls, where last week, that 4-week moving average of continuing claims, which at that point in time ended September 12th, was at 12.7 million. Today's report for continuing claims, which it was for the week ending September 19th, 4 weeks going into September 19th, that dropped to 11.7 million. So although the weekly claims is a very stubborn number to get down, we want to see it drop below the 800,000 level hard. Continuing claims, there were 1 million people that dropped off the rolls. That is a positive sign, but we still want to see a lot more progress there. Now, we also got personal income and spending numbers, and we got the PCE data, which is inflation. And we're going to go into that. I'm going to do it without being too wonky because this data stream does get a little technical on occasion. Just try to bear with me. So, personal income for personal income for August, I believe. This was for August. Yes. Okay. The actual number came in at a decline of 2.7%. All right. That was against an estimate of a decline for 2.4%. Personal spending rose 1%. So there are some economists and there was some comments in going around today that is not a positive sign. Clearly, if you have personal income dropping on a month-over-month basis from the prior month and personal spending increasing 1%, that means that people are spending a little bit out of savings. And that's a trend that, can't really continue without doing some damage to the economy. But I think that some of this will be explained by, I think a lot of it's explained by the drop off in the enhanced unemployment payments that were going on through July. It ended at the end of July. The personal income and spending numbers were for August. This is one of those pieces of data that's on a full month lag, where, for instance, tomorrow we'll get the September jobs report. That's for September. The personal income and spending report that we just got this morning is for August. Since the enhanced unemployment kicker of an extra $600 per week ended at the end of July, that was a drawdown on personal income for the month of August. Now, the bright side is that the spending rate was so high with everybody locked down under the coronavirus lockdown, not going out, not going to restaurants, not going to bars, not traveling, not making business trips, just basically going to the grocery store, cooking and eating at home, maybe some food deliveries, that the savings rate had been so high for a few months. And in July, it was 17.7%. That is an astronomically high personal savings rate. That dropped in August to 14%. That is still a very high personal savings rate. So even though you will hear some chatter, and I heard it today from the numerous commentators, that this is negative because personal income dropped 2.7%, while personal spending increased at 1%. That means people are spending out of their prior savings. The savings rate was so high for June and July, and probably even for May, that people are able to absorb that. And even frankly, for August, the personal savings rate at 14% is very, very high. The positive is that people have been paying down some of their credit card debts. They've been saving money. So now if you don't have a stimulus 4.0 deal, and you don't have this extra unemployment kicker officially kicked in beyond Trump's executive order for it to happen, I think that people's savings rate was so high for a couple of months, and even very high in August, that they'll be able to absorb another month where personal spending is maybe a little bit higher than income, if that happens again in September. And we won't get that report until very early November. Now, core PCE, and this is a month over month plus 0.3%. Year over year, the core PCE increased. This is basically a measure of inflation. In fact, it's not just a measure of inflation. It is the Federal Reserve's most favored, and what they consider to be one of the key measures of inflation that they look at. And when they talk about that wanting inflation to hit the 2% level and stay there for a sustained period of time, they are looking at either the headline PCE or, more preferably, the core PCE, which excludes food and energy. So core PCE year over year is running at plus 1.6%. That's well below the 2% target that the Fed has. Headline PCE, which is running at an even lower rate of plus 1.4%. So you can see that we could have these month-over-month increases in core PCE and headline PCE. Month over month, it increased at 0.3%. We could have that even tick up a little bit, and we're still not going to have this year-over-year number, which is what the Fed is going to look at, hit this 2% level for a while, much less stay there for, as the Fed has said, some period of time. Okay, now that was a lot, but we also had quite a bit more. We had within this whole personal income and spending number, we had real disposable income in August declined 3.5% month over month after it was unchanged in July. Again, this is a direct effect of the $600 extra kicker for unemployment being dropped off after the end of July. Okay, with 10 million, 12, 11 million, well, the continuing claims at 12 million people still unemployed. It was a little bit higher at the end of August. That has an impact on people's income. So, spending up 1%, personal income down 2.7%. People are spending a little bit out of savings, but they've saved at a much, much, much higher rate during the economic lockdown, which makes sense. People don't even have to commute to go to work. They're working from home. They're buying a lot less on gas. They're not buying their their monthly commuter train ticket if they're in a large metropolitan area that has mass transit. They're not spending $10 to $15 for lunch, or even more than that in some locations. They're working at home. They're living at home. They're not commuting. They're going to the grocery store a lot more, and because of that, they're saving a lot more. So this isn't what we want the economy to consist of. Certainly, longer term, we want everything to be normalized. But I think the point is that the personal savings rate has been so high for the last 3 to 4 months that people are going to be able to withstand a few months, another 2 to 3 months, 4 months. Clearly, we don't want to see people out of work. We don't want to see people that have absolutely no means go into hardship situations. But the saving rates has been astronomically high, certainly against any metric over the last couple of decades. That's the one positive. Okay, now that was a lot. We had other data today. We had construction spending again for the month of August. This is a piece of data that trails by a full month when it's reported. And because of that, it's largely hard data. It's not a lot of surveys. Up 1.4% month over month versus the month of July. In July, construction spending increased 0.7%. Look now, this beat August was better than July, twice as good. It increased 1.4%, and it also increased 0.8%. It beat the consensus of 0.8%. This is largely housing. Okay, residential was almost all of the increase. The number for non-residential was about flat. We're in a housing boom. I'm sure you've heard it a zillion times. It's probably going to stay that way for a while. Mortgage rates still easily below 3%. I think at 2.88 I saw today. We also had the national ISM manufacturing report today. Now, this is a private number. That's a lot of surveys. A lot of it's about how people feeling, what they're, et cetera, but it also does measure orders and a number of other metrics. Now, we mentioned yesterday that the Chicago PMI number, that's a Chicago Purchasing Managers Index. That's kind of the Chicago Fed region version of the national ISM number. That had a huge jump up to 60 from about just up to, I think it was 61 or something like that, up from just above 50 the prior month. Very rare that we get a jump that high in that Chicago number, but we did. Now, today's expectations were for a number to come in at 56 for the national number. I commented maybe we get a strong beat. Well, we didn't really get a beat. It came in at 55.4 versus 56 in August and versus maybe 56.5 consensus. But it's still shows that the economy is expanding at very close to the same rate that it was in uh, in August. Okay. Now, 50 for this ISM number for both the manufacturing sector and the services sector, that's the expansion contraction threshold. If you get a number above 50, the economy is expanding. You get a number below 50, the economy is contracting versus the prior month. Okay, so in August, the economy was expanding. It wasn't expanding 56%, but that was the metric. That was a number on the metric that is that the measurement is keyed against. So in September, the economy was still expanding at the same rate that it was in August. It wasn't expanding at a significantly higher rate, but it was still showing growth. And that is important. Now, let's take a look at they break it down into 5 categories. And I think this is important to look at also. Excuse me. So the national ISM number, new orders came in at 60. That was a decline from 67. 67 was just an off the charts number. That was a number from August versus July. We'd been in an economic shutdown. It took a lot of these companies time to get their employees back. It probably a 1 month lag from businesses realizing they need product to actually putting the order in to the manufacturers, acknowledging those orders and recording them. And that number hit 67 in August, up from probably a very low number the month before. So we declined to 60. That's still a very strong number. The employment index for the sector, employment's been an issue. Employment's the biggest hurdle right now in getting the economic growth to look like a V-shaped recovery. Okay. The employment index did increase to 49.2 from 46.4, just a touch below 50, but it did increase. So that's, I think, constructive. Now, the backlog of orders increased very, very slightly. 55.2 from 54.6. Backlogs are always positive. It shows that these companies that are manufacturing goods have more work to do to fill the orders they have on their books. Prices paid increased a little bit, up to 62.8 from 59. So that shows that some businesses and some manufacturers are having some pricing power. If prices are going up a little bit, it's probably certainly not happening in the energy sector, but in a lot of other sectors, they're in seeing some ability to raise their prices a little bit. Obviously, that will help their margins and their bottom line. Now, the inventory index. That's like of the people that are ordering goods through the manufacturing chain. Their inventory index declined very, very, very slightly, but it was at 38.1 in August. It's now at 37.9. That is the lowest rate for the consumer inventory index. And when we say consumers, we don't mean individuals, but we mean businesses that are ordering from manufacturers of anything, any type of product, hard goods, soft good, retail, just any type of manufactured product. That's the lowest level for that subsector of the national ISM index since June of 2010. Okay. So when we had the global financial crisis, the bottom was in March of 2009. We hit the lowest level for those inventories in June of 2010, and we had a decent bump in that. Now, the reason that low inventories are bullish is that means when these companies get a little bit more online and when they get a little bit more final consumer demand start to increase for whatever, clothing, hard goods, soft goods, et cetera, et cetera, et cetera. When they get more demand for their product, inventory, there'll be a tremendous pent up demand for product in the pipeline since inventories currently are at near record lows. So that one, ironically, the one subsector of the manufacturing survey that's extremely low, it's actually bullish that it's extremely low, because it means when we start to really get the economy running at that next level up from where it is now, there'll be a pent up demand for inventories in the pipeline. So that's the ISM report. Now, and just to give you a little bit of historical perspective, when we were at the absolute lows of the whole coronavirus economic shutdown, et cetera, et cetera, et cetera, in April and May, the national ISM index came in at 41.5 in April and at 43.1 in May. Okay. 50 is the expansion contraction threshold. So those numbers have increased. We had a big bump in June, measured off the very low number in May of 43.1. Then in July, we had a bump. In August, we got up to 56.0. We're still almost there. We're at 55.4. What a contrast from when we were in the low 40s in April and May. So, look, the market liked all this economic data. We had a strong, that number came out at 10 o'clock. The market rallied after that number came out, went a little bit higher. But then we kind of started to get hit by running into a little bit of technical resistance and these additional comments from people. No, we're not hours away from a stimulus 4.0 deal. We're probably not even a day or two away from a stimulus 4.0 deal, but they are talking. There is a little bit of movement. I just think it will be a factor of how stressed the politicians in Washington feel to move off what their last option was, respectively, for both the Republican and the White House side and the Democratic side, and make a deal for a stimulus 4.0 plan. Even if they made the deal tomorrow, miraculously, it's questionable whether the money would get into the system and into the hands of the people it needed to get into the hands of to show a significant impact one way or another before the election, which is like 1 month and 2 days away. So I think the market is going to go back and forth, up and down. We're going to have these volatile moves intraday based on every little comment that has to do on whether we're closer or not close. Are we going to have a stimulus plan? Is it still, 1.6 billion offered at 2.2 billion? And then what's in that 2.2 billion? Are the Democrats still asking for stimulus checks for illegals that are in the country? Are they still asking for cities to be bailed out from all of their self-imposed economic hardships that they've created for themselves over the last months, years, decades? If we get some type of a compromise, and everything we hear, every headline, every comment that comes from Pelosi, Mnuchin, McConnell, Larry Kudlow, other key political figures on both sides of the aisle as to whether we're close to a deal or not close to a deal, the market's going to have these volatile waft up and waft down. At one point in time, the Dow got hit by like 150 points in the span of 3 or 4 minutes based on a couple comments that were made. So this is just going to be the way the market reacts for the next, few days, maybe a week or so, until we either get a deal or until people say we're so close to the election now, a deal's not going to happen until after the election. And and the other big component of this deal, the one thing that I think really might spark a deal to happen, is that the airline industry is in critical need of additional money. They're running at 60% capacity at best. It's an intolerable situation for them from a sustainability standpoint, and they need this is an industry that you cannot just let fail under the idea that we're a capitalist system. Sometimes companies go out of business. This is not a situation that they caused themselves. And believe me, over the last 2, 3, 4, 5 decades, the airlines have created a lot of self-induced economic pain for themselves through just stupid things that they've done from time to time. This is not one of those times. This was a self-imposed economic shutdown on the entire country, where airline traffic decreased by 95% in late in the second quarter and early in the third quarter. And both sides of the aisle are going to agree that the airlines need an additional lifeline to get us through whatever we have to get through to get to the point where they can run at a much higher capacity. So that was kind of a lot. We will get the jobs report tomorrow morning at 8:30. The expectations are for about 1.3 million jobs. Actually, I'm wrong on that. I think the expectations are for 850,000 jobs. The ADP report yesterday was a beat. I don't know if it will be a predictive indicator for what we see tomorrow or not. It's a little bit encouraging that we had over 1 million people drop off the continuing claims rolls for the week that ended September 19th. And the survey week for the jobs report was the second full week in September. So that was probably the week before that. But look, there's obviously been some additional layoffs announced in some industries. The airlines, right there, they're to the point where if they don't get a bailout by early next week, they are going to lay off tens of thousands of people. And nobody really wants to see that, but it might happen. And clearly we have had also some layoffs. I think Disney announced maybe they're going to lay off 12,000 people or something like that at their theme parks. Clearly the traffic at their theme parks is nowhere near even probably 50% capacity. And they employ probably hundreds of thousands of people at all of their theme parks globally. So they said, I don't know what percentage of their total theme park staff that is, but I believe they read they were going to lay off 12,000 people. I'm not sure exactly what the date was. So that's one of the things the employment picture is struggling with. The airlines, the theme parks. Even the cruise lines today got a little bit of a negative headline when the CDC said no bookings until, I don't know what their date was, but it was maybe a little bit further out than what the cruise industry was hoping for. So that's pretty much all I have. I want to thank everybody for watching. And this is the Anderson Report. I'm Tim the Source Anderson. This is my YouTube channel. If you have not subscribed yet, hit the subscribe bar, the little bell next to it. And you can always watch it on replay if 7 o'clock is not a good time. There'll be days when I do it at 9 o'clock. And no time is perfect for everyone. I realize that. And it is always available on replay. And I know a lot of people that watch it the following morning. So I also broadcast on Periscope at TJ Anderson 12. And my Twitter handle is TJ Anderson 1. I want to thank everyone for their support. Big Fish, it's great to see you in the chat. I hope this was informative and not too much excruciating detail, but there was a lot today, and I didn't want to. I wanted to try to hit a little bit of everything. So everyone have a great evening, and the employment report tomorrow, 8:30 a.m. I'll have some comments about that on Twitter right shortly afterwards, and I'll probably do another broadcast tomorrow evening. Thank you and enjoy the rest of your Thursday. Everyone stay safe.